Silver has increasingly shifted from a traditional precious metal to a critical industrial commodity, and the reality of its market structure is reshaping how global supply and demand interact. For years now, production of physical silver, from mines and recycled sources, has consistently fallen short of total consumption from industrial users, technology sectors, and even investment channels. This consistent gap between production and demand is called a supply deficit, and unlike temporary mismatches that resolve quickly, today's deficit in silver has become structural, meaning the imbalance has continued year after year rather than correcting itself. According to industry research from the Silver Institute and independent analysts, the global silver market recorded its fourth consecutive annual supply deficit in 2024, with demand exceeding supply by nearly 149 million ounces. This built a cumulative shortfall of approximately 678 million ounces from 2021 to 2024, nearly the equivalent of 10 months of global mining output. What makes this structural stance important is the role silver now plays in the modern economy. Industrial consumption, especially from sectors tied to the energy transition, has become the dominant driver of total silver demand. In 2024, silver industrial demand reached a record high of about 680.5 million ounces, driven by applications in renewable energy installations, electrification of infrastructure, and advanced electronics. These applications include photovoltaic, solar systems, electric vehicle components, grid infrastructure, and artificial intelligence hardware, technologies that require silver for its excellent electrical and thermal conductivity. This shift toward industrial use fundamentally alters the traditional view of silver. Historically, silver demand was more evenly distributed across jewelry, silverware, and investment demand. Now, over half of total silver consumption comes from industrial applications, in some analyses over 58%. This means that even if investment demand moderates or jewelry consumption fluctuates, the baseline industrial requirement for silver continues to grow, reinforcing the structural imbalance. At the same time, supply has not expanded sufficiently to match rising consumption. One major reason for this is that most silver is produced as a byproduct of mining for other metals such as copper, lead, and zinc. Because the economics of these primary metals often dictate overall production volumes, silver output does not respond dramatically to silver price movements alone. New silver-only mines are rare and take many years to bring online, if at all. This structural limitation on silver production means that even when demand rises sharply, the supply response is muted. Even recycling, another source of secondary silver supply, cannot fully compensate for the growing demand from industry. Although recycling increased in recent years, reaching multi-year highs, it remains a relatively small percentage of total supply compared with primary production. Meanwhile, mining output itself has shown only modest increases. In 2025, total silver supply was projected to increase slightly, but not enough to close the gap between industrial demand and available metal. Estimates suggest a deficit of more than 100 million ounces for 2025, marking the fifth consecutive year where demand will outpace total supply. Another important factor compounding the structural deficit is the drawdown of above-ground inventories. Inventories held in major exchange vaults and storage facilities, which historically served as a cushion during periods of tight physical market conditions, have been significantly reduced over the past several years. Declines in inventory levels intensify the impact of ongoing deficits because there is less buffer metal available when physical demand rises. While these stocks still exist, their diminished size means the market has fewer tools to balance supply shortfalls without impacting pricing or physical availability. Independent market reviews indicate that these drawdowns have been significant, with inventories declining steeply from earlier peaks. The combination of structural demand growth and constrained supply is also reflected in price behavior. In 2025, silver prices rose sharply, reaching multi-year highs and breaking through levels not seen in decades. Market data showed silver trading near historic peaks late in 2025, driven by ongoing deficits and heightened demand dynamics. These pricing levels were grounded in actual market conditions, not projections, a clear sign that the persistent supply deficit was being factored into global trading. A deeper look at demand drivers reveals why supply has struggled to catch up. The solar photovoltaic (PV) sector alone has become one of the largest consumers of silver. Industry reporting highlights that solar panel manufacturing could require a substantial share of current annual silver production, potentially more than 20% of total supply by the mid-2020s, due to rapid global growth in renewable energy installations. Even though manufacturers attempt to reduce silver usage per panel, a process known as thrifting, overall demand continues to rise because total solar capacity is expanding so quickly. Electric vehicles and broader electrification trends also contribute significantly. Electric vehicles contain more silver in their electrical systems than traditional automobiles, because of the additional electronics, sensors, and charging stations involved. As global EV adoption accelerates, this adds incremental silver demand that traditional mining growth cannot easily absorb. It is also important to understand that industrial demand changes tend to be inelastic, meaning once equipment or infrastructure requires silver, that demand does not shrink significantly even if prices rise. This characteristic further reinforces the structural nature of the deficit. Even with periods of slower growth in some industrial segments or shifts in investment flows, the overall pattern remains clear. Demand continues to outpace supply on a structural basis, and this has persisted through multiple consecutive years. Continued deficits from 2021 through 2024 have built an accumulated imbalance that cannot be corrected quickly due to the long lead times and high capital costs associated with expanding mining operations or developing new primary production sources. This persistent supply deficit has meaningful implications, not only for commodity markets, but also for industries and investors that rely on silver. Manufacturers must plan ahead for physical sourcing, and financial actors are paying more attention to the interplay between industrial demand, inventory availability, and pricing trends. The supply shortage is not a short-term glitch. It reflects deeper structural shifts in how silver is produced and consumed globally, a trend likely to remain central to discussions about silver through 2026 and beyond. Silver's structural supply deficit continues to influence how both industrial consumers and financial markets view the metal as 2026 approaches. What distinguishes silver today from many other commodities is the depth of its imbalance between supply and demand, a gap that has not only persisted but grown cumulatively over several years. Data compiled from independent market surveys and industry reports show that from 2021 through 2024, the global silver market experienced significant deficits each year. These shortfalls, measured annually in the hundreds of millions of ounces, have added up to nearly 800 million ounces of cumulative unmet supply, equivalent to almost a full year's worth of global mining output. This long-running deficit reflects a combination of structural demand growth and supply rigidity. While some metal markets will respond to price with increased production, the nature of silver mining means that most output comes as a byproduct of other metals such as lead, zinc, and copper. Because production decisions for these metals are driven by their own market economics, silver's supply does not react quickly or proportionally when silver demand rises. In 2025, estimates suggest that close to 81% of global silver mine output will be consumed by industrial demand alone, leaving limited metal available for other sectors. One key driver of rising silver consumption is the energy transition, particularly solar photovoltaic PV installations. Solar panels use silver in their electrical contacts and conductive layers due to its unmatched electrical and thermal properties. While technological improvements have slightly reduced the amount of silver needed per panel, the overall pace of global solar capacity expansion continues to elevate total silver demand. Analysts report that solar PV alone accounted for a substantial portion of global industrial silver use in recent years, and it remains one of the fastest-growing segments of consumption. Similarly, the electric vehicle, EV sector, and broader electrification trends contribute materially to silver demand. Modern EVs incorporate more electronic control systems, sensors, and power electronics than traditional internal combustion engine vehicles, and all these systems require conductive materials like silver. One industry report noted that EVs may use between roughly 25 to 50 grams of silver per vehicle, quantities that add up quickly when scaled across millions of units globally. Beyond solar and EVs, silver's role in digital infrastructure has expanded. Ever-growing data center capacity, 5G deployments, and new technologies related to artificial intelligence and the Internet of Things rely on silver for connectors, circuits, and high-performance components. As global IT infrastructure expanded over the past 2 decades, silver usage in electronics and related sectors has risen sharply, reinforcing its position as a material critical to modern innovation. This rapid rise in industrial consumption has outpaced mining production, which has only increased marginally despite demand growth. Mine output remains constrained by the pace of new project development, geological challenges, rising costs, and limited exploration success. These supply constraints are compounded by declining above-ground inventories, stores of silver held in exchange vaults and inventories, which have been drawn down repeatedly to meet demand, leaving fewer buffers when deficits arise. The interplay between shrinking inventories and structural deficits has influenced physical market conditions more tightly than in many other commodities. Warehouse stocks in major exchanges have tightened, and physical metal premiums occasionally rise above paper pricing, signaling that physical availability is limited relative to contractual claims. These conditions underscore how deficits are not just numbers on a chart, but realities in physical markets where industrial users and bullion dealers operate daily. Investment behavior also reflects these underlying fundamentals. Although industrial consumption dominates total volume, investment flows through bars, coins, and especially exchange-traded products backed by physical silver influence market balance by removing metal from available supply. In years where investors add to silver ETFs or hold physical metal outside of circulating inventories, the available physical pool shrinks further, intensifying the lingering supply-demand gap. Many institutional reports highlight that while investment demand fluctuates over time, its interaction with industrial demand in a constrained supply environment amplifies the structural deficit narrative. These structural factors help explain recent pricing behavior. In 2025, silver reached multi-year highs, reflecting the tightening balance between industrial consumption and physical supply. Market data from late 2025 noted silver trading above levels not seen in decades, underscoring how deficits and rising demand have been priced by global markets. While broad economic conditions such as currency movements or interest rate expectations can influence metals pricing, these macro factors interact with the underlying supply deficit to shape overall market dynamics. For industrial sectors, persistent deficits mean that procurement and supply management decisions must adapt. Manufacturers in solar, automotive, electronics, and other segments need to account for the reality that silver availability may remain tight relative to demand. These firms often hedge supply needs or secure contracts well in advance to ensure continuity of production materials. These operational adjustments show that the deficit is not an abstract concept. It affects planning, budgeting, and inventory management in industries relying on silver. From a financial perspective, silver's evolving role highlights its dual identity as both a strategic industrial commodity and a financial asset. This dual demand profile makes silver unique. Industrial consumption provides a stable baseline of demand that is less elastic, meaning it does not diminish quickly in response to changing prices. At the same time, investment interest can add volatility and influence price levels, particularly amid shifts in broader market sentiment. The structural deficit, as well as diminished inventories and shifting industrial demand patterns, plays a central role in shaping these financial narratives. Understanding silver's market dynamics requires appreciating how the cumulative deficit, industrial consumption patterns, and supply constraints interact. This complex interplay helps explain why silver remains a focal point for commodity analysts, industrial planners, and financial professionals heading into 2026. These factors do not yield quick fixes or easy adjustments. Mine development cycles are long, inventories are already reduced, and industrial demand shows no signs of disappearing. As a result, structural scarcity, rather than short-term fluctuation, increasingly defines the silver market's character. In practical terms, this means industry participants and market observers pay close attention to periodic reports on production, consumption, and inventory levels to monitor how the deficit evolves. These reports, produced by industry bodies and independent consultancies, update key metrics like total supply, industrial demand segments, and cumulative deficit figures that are essential for tracking long-term trends. Taking a broader view across multiple years helps put current conditions in context, showing how structural demand growth and supply limitations are not momentary but persistent realities in the silver market. In summary, silver's structural supply deficit is no longer a short-lived market feature, but a defining characteristic of its modern landscape. The consistent yearly deficits, combined with rising industrial demand, especially from solar, EV, and digital infrastructure sectors, and limited supply response due to mining realities and inventory drawdowns, create a sustained imbalance. This lasting condition influences both industrial decision-making and financial market behavior, as stakeholders assess silver's role within broader commodity and manufacturing ecosystems.